Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing another stock analysis for Sprouts Farmers Market. I just bought this at the beginning of this year. If we come down here, January 21st, I bought it at $72, and that was pretty close to it bottomed out at 65. So I was a little bit slightly higher than where the bottom was. Um, and I'm pretty happy with my position here. It's not a super big position, but it was a good enough size for me at that time. And so far, I'm up 25%, so I'm happy with that. Sprouts Farmers Market. I've been there many times. It's a great store. It's if you don't know, it's primarily a health food store. It's not super big. It kind of has like a farmers market type of feel. And this company is only an $8.8 billion market cap. Right now, it's at 17 times earnings. When I bought it, it probably was at like a 14 or a 15 or something. That was part of the reason I was bullish on this. And then the company was founded in 2002. And so we're going to see what's been going on with the stock and how come it's up. I mean, it was actually up higher today. It went up to 94. It was up 7% today, and then it dropped for some reason. But the stock is up, over 32. It was up 35% this morning just in the last couple of months. So it's been doing pretty good. If we take a look here at the valuation, we can see that revenue has been growing somewhere around 10% a year for the last couple of years. That would be about the average. They did 8.9 billion in sales, which is it's trading about a price of sales of 1. That's very good. Revenue growth of about 7-8%. So the revenue growth is slowing just a little bit because let's see, last year they did 10% and then 12% the year before that. So it's slowing, it is slowing a little bit, but at the same time, pretty much all retailers are struggling. Pretty much every retailer is struggling right now. Between Target and just all the other retailers I look at, a lot of them are struggling. So they're supposed to do 9.5 billion in sales this year, 10.2 next year. Good enough for me. EPS is also looking good. 5.3 last year up to 5.5 this year, then 5.9 next year. Nothing crazy. It's not super fast growth, but I just really like the store. I think they have a consistent business model here. And the net income it was kind of flat, trending down a little bit, so not great. But I'm pretty bullish that they're gonna kind of just add more stores, continue to grow. They've been buying back shares for a 4% share buyback or 4% reduction in shares, I should say, over the past year. That's really solid. Then we come over here, profit margins are at 7%, very good compared to where it normally is. And so I'm really happy that margins are improving, which is kind of weird again because we are in an inflationary time where a lot of companies are struggling with margins. Return on capital employed is about close to 20%, very solid for a company like this. I believe that's higher than these other ones like Target or Home Depot. Then we come to valuation. So it's been all over the place. Here's the past 5 years. As you can see, it was at 2021 and was at 9 times earnings, and it scaled all the way up to 47 times, which is insane. And then since then, it went all the way down to 12. And so let's see, I would have bought it. I was buying it at what, 15 or no, probably 13. Yeah. I was buying it at 13 times earnings. See, that's cheap. And so it's coming back up a little bit. It's in a much healthier spot now at about 18 times. Although I mean it's definitely possible for it to go higher. I feel like 20 times might be even a better um, valuation for this. So 20 times earnings would be somewhere in the middle kind of. I could see it hanging out around 20. Free cash flow yield is down a little bit, unfortunately, and then price of sales is doing the same thing as the PE. So that was one of my main thing in this was just that the PE had dropped so much from the 40s all the way down to a 12, and I was like, okay, this is. It's I don't know why it's being priced like that. But at the same time, you look at Target trade down to 10 times earnings. So, inflation and demand, customer demand and stuff, these things can definitely weigh down these retailers big time to the point where they're trading at 10 times earnings, which is extremely cheap. And so that's what we have there. Then we come over here and we have the price targets or analyst price targets for off of Claude. And I like the way they laid this out because so they have the bull case all the way over here, which is the extreme version. They have the bear case of 70. So between 70 and 190, the mid range of that is like what, 130 or something? I don't know. Yeah, somewhere around there. We have certain analysts and their price targets, and then we have the average, which is 108. So let's see, what is that? So that's okay. So that's the average, not based off of bull and bear, but probably based off of these other analyst estimates. So and that, I mean, again, I'd be happy with anywhere around a 20 or 22 times earnings. That would be pretty happy. I'd be pretty happy with that. So if it does go to like $108 or so, 110, I mean, to be honest, unless this one jumps to an absurd valuation to where it goes to, I don't know, 35 times earnings or something. In that case, if that happens this year, I probably would sell it. Like me, I probably would sell if it went to 35 times earnings or something crazy. But most likely what's going to happen is it's going to stay between 15 and 25 this year. And I mean, that's what I want, honestly. I'd rather have slow and steady growth and maybe get I don't know, maybe a 60% return on this and sell it next year. That's more my goal because this year I really wanted to kind of make it where my investments I held for longer than a year, so that way I didn't pay any taxes. Because your first 48,000 in long-term capital gains profit is taxed at 0%, I believe. So that's my goal. It's just to do, hit that $50,000 of profit this year in long-term capital gains, and that way I'm not paying any taxes. That's really what I wanted to do. So I definitely would like to hold this into 2027, and then maybe sell it, probably sell it 2027. I don't know. We'll see. But yeah, I'd like to get at least a 60% or 70% return on this and just hold it into next year. So although, and this is a 12-month target, so maybe next year the stock will be 110 or something like that, which I think it could even be more than that, really. We'll see what happens. Then we have EPS forecast. We're looking at next year at about $6.56. That's a little bit. This must be, maybe this is for adjusted earnings. Let's see, $5.81. Yeah, I feel like they're a little bit ahead. 2028, 732. Yeah, they're a little bit. I don't know what they're a little bit. They're kind of being too bullish with that. Net income forecast next year 639 million. How does that relate to what they've been doing? Let's see. Net income these past couple of years was 500 million. Could they really do 639 million next year? I don't know. It's maybe 712 million. They might be. I think they're being too bullish with that. Annual revenue. Let's see. $9. Okay. About 9% growth expected. Analyst ratings, Bank of America, buy, mostly buys. Um, Again, anywhere from 90, 90 to 190, maybe 120. So that like 110 mark is probably best case scenario. But again, even if it hit 110 next week, which would be awesome, I don't know if I'd want to sell it. I don't know. I'm trying not to sell it in the short term. So let's see what we got down here. Okay, EPS 581. Wall Street analysts forecast their EPS. See, that seems way too uh, optimistic. I don't know about that. Those are some high growth numbers. They are forecasted to grow revenue at 9% per year, even though Yahoo says 7%, whatever. Anywhere around there is good. Um, and again, you want slow and steady growth because you see some of these other companies, whether it's retailers or not, where the stock might trade at 100 times or 200 times earnings because it's all hyped up and they said, "Oh, we're going to grow it 40% a year." But then they kind of maybe they grow like that for like 3 or 4 years and then all the growth is gone, right? Because they've already expanded too fast and then profitability went way down. The free cash flow is negative, profitability is way down, and it's just like I mean, it's just not like a good way to do it. It's not a good way to expand your business, and it's not a good way it's not a good situation to be invested in that because then the stock explodes at the beginning and then in the long term it doesn't go anywhere. And that's kind of like what you see right here with the way it went from $20 to almost 200, I mean it went up whatever over 500% in just from 2022 to 2025. So again, that's kind of what happened there. And now we're coming back down to more realistic valuations. So that's what I like. Price targets, key risks, management cited macro pressures like fuel costs and tariffs, and blah, 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 blah. E-commerce sales surged 10% to represent 16% of total sales, and the company launched 1,500 new products. Wow. While opening 6 stores. See, that's not a lot. So that would equate to like 25 stores a year. And that's a good amount. That's again, that's like a healthy amount to where they could probably handle that without it being too much of a burden. Expansion showing strong performance in new markets like New York, Texas, and Florida. Phenomenal. So my plan is to hold this until next year. Hopefully, I'll probably sell, I'm hoping to sell it like $120, something like that. We'll see what happens, but unless the stock explodes this year, I do not plan on selling it. So that is my analysis for Sprouts. Let me know what you guys think down below, and I will see you in the next video.